today's webinar, we're going to talk about the resilience. You know, there's a there's a lot going on in the economy today, a lot going on politically, all kinds of things. And what I wanted to talk about is how investing in this space in an alternative asset is a good safeguard in really uncertain times like we're in right now.
Mhm.
I'll start by telling you a little bit about First Shield. Our mission is primarily to unlock the potential of mortgage note investing for our clients. We're committed to providing innovation, reliable investment solutions in a framework of expertise, integrity, and we have results-driven strategies. I like to say that, and it's one of those things that I say it so that I just keep reinforcing this is what we're about.
Mhm.
Note investing is a really interesting industry because we are the bank. The business provides consistent cash flows. And during this presentation, I'm going to be talking about what is note investing, why mortgage notes, the types of notes that we invest in, and also how can you, as an individual, get involved in the note space and invest in notes yourself. You'll hear a term called alternative assets. And people use alternative assets when they're building a portfolio as a way to safeguard their wealth from things like volatility, um, uncertainty in the banking space, and to hedge against inflation. So typically, when you think about building a portfolio, and what most people look at, and most people they think about the stock market, they think about bonds, things of that sort. But there's a whole universe, a whole plethora of other investments. And the note investing space falls into that. It is an alternative asset and it does help to safeguard your portfolio against the volatility of the stock market. We are totally uncorrelated to the stock market. And because it is a cash flow based business, you have a lot of certainty about where the money is going to be coming from and how and when you're going to get your payments from a borrower. So again, you relieve that uncertainty that you'll get from a stock investment or some other kind of alternative investments, crypto and things of that sort. One of the things that we've done as a way to help people to diversify is we've put together what we call Covenant Fund One. Covenant Fund One provides above average returns for our investor base, and it also protects their downside. In the real estate space, because we're investing in real property, the notes cover and protect our investors' capital to keep them from having that level of volatility and loss of the capital investment that they have. When we talk about note investing, we talk about and what the things is that the Covenant Fund invest in. We primarily talk about second mortgages, and second mortgages for most of us, we hear the term home equity line of credit. That's basically a second mortgage, um, as opposed to the first or the primary mortgage that most people have. Second mortgages are typically taken out on properties that have equity and fairly significant equity. Banks have some pretty stringent guidelines about what they will do before they provide a second mortgage. At First Shield, we buy performing and non-performing seconds, both on the residential side or primarily on the residential side, but we will pick up some commercial if it's a multifamily type of property. Uh, we talk about performing and non-performing. In our world, a non-performing loan is one that the borrower has not made a payment within the last 90 days. We buy those because we can buy them at a pretty good discount and get a really good capital gain out of those notes. We also do short-term loans, both on the for residential and commercial projects. Again, those commercial projects are multifamily type of dwellings, and we can use up to 25% of our funds for that. We use that as a way to kind of balance out our portfolio to make sure that we're able to give the dividends, the quarterly payouts to our investors. I'm going to talk briefly about how the fund works. As I mentioned, we invest in mortgage notes. I mentioned we invest primarily in seconds and primarily non-performers. And the reason for that, again, is because we're trying to make sure that our investors are getting that up, the capital gain from our success in investing in non-performing mortgages. Typically, we buy non-performing mortgages at a 55% discount off of the value of the loan. And because of that, we know that we're going to be able to get some pretty good returns for our investors. The other thing about the fund is we give a quarterly yield, a quarterly dividend. So that dividend ranges from 8% up to 12%, depending on how much an investor invests in the fund. And we do that so that we can provide a steady income for our investor base. The next thing that I want to say about the fund is at the end of the fund, this is a 5-year fund, and it sunsets in December 2029. At the end of that time, 100% of the capital that our investors have invested will be returned to them, and 50% of the net profits from the fund will also be returned. Because we're investing in non-performing notes, we feel that we're going to see some substantial returns overall for this fund. And as a result, we'll be able to pay out that 50%. If you want more information about the fund, you can go to our URL. I'll give you a second to kind of scan the code here, and you'll get a chance to get on my calendar, and we can talk in more detail and answer any questions that you have about the fund. I want to talk a little bit now about the benefits of investing in notes, in mortgage notes. The reason we've invested in mortgage notes and the reason I got into this space is because borrowers pay consistently and for a performing mortgage note. So one of the things that I like and one of the reasons for getting into this is that I know that I have a steady, regular income. Many folks that are investing in real estate come to the mortgage note side from having invested in real property, being a landlord and things like that. If you're a landlord, because of turnover, all those kinds of things, your income tends to bounce up and down. It tends to be volatile. What we find with borrowers for houses, homeowners pay their mortgage. One of the things that we'll see when we're doing our investigation of looking at a mortgage is you'll see the consistency. People take pride in their houses and they make sure that they're making their payments. So that's one of the benefits of investing in notes. The other advantage that we have, or the other benefit that we see, is a higher overall return because we are investing in the notes. I mentioned because we are doing some non-performers, we know that there's a possibility of an investment doubling over the time that we are invested in that note because we're buying it at such a low discount. And finally, the benefits of investing in notes is making sure that we have some good back office loan support to make sure that we're processing all of the paperwork and that kind of thing in an orderly and expeditious fashion. Covenant Fund invest over most of the United States. There are some areas that we are not involved in. They're primarily on the West Coast, but we also don't invest in some of the states in the Northeast, New York, New Jersey, Massachusetts, as well as Cook County in Illinois. The primary reason for that is that those states tend to have, if you do go to foreclosure, a much longer foreclosure time horizon than we want to have in our portfolio. They're not bad states to be in, but for our buy box and for our investment strategy, those states have a little bit longer time horizon, and we don't dial that time horizon into the notes that we buy. I want to take you through a case study. We talk about non-performing notes, and one of the things that a lot of folks say, because we're doing non-performers, it sounds kind of like an oxymoron. Why would somebody buy a loan that a person isn't paying on? So I'm going to talk about that a little bit with the case study. But before I get into that, I'll also talk a little bit about what kind of notes do we buy? When we buy a note, and the reason I say that we will do a non-performer, and the reason we will do a second is that when we buy the note, there is a lot of equity in the house. So typically, for the notes we buy, the borrower has more invested in the house than we do with the note that we buy. So even though they may not be paying, what we tend to find is that there is a reason for not paying. You'll typically see that the borrower was paying for for years, and then all of a sudden something happens. I like to say it's not uncommon for bad things to happen to good people.
Mhm.
So what we'll see is, and I call them grade A non-performing notes, because the borrower before that event, their FICO score was up there. They're paying all of their bills as they've agreed. They don't have a lot of massive debt. They're just sort of average people doing things. But then something happens. There's a death in the family, a divorce, job loss, something that knocked them off balance, off kilter, and now they're not able to make their mortgage payments. Net result, we wind up with a non-performing note. In this particular case study, I wanted to talk about a house. I think it was I know it was in the Midwest. The first mortgage was 95,000. The overall home value was 132. So the borrower had $37,000 of equity in the property. So you have a loan to value of about 72%, and your interest rate was running at 3.75 or 5.375%, sorry, and a monthly payment of 649. That particular note was one that was very attractive to us. I don't have the slide that kind of tells you what our overall returns were, but we bought the note at a very good discount, roughly 50%, so about $40,000 for that particular note. We work with the borrower. We're able to turn it around and help the borrower out to refinance that. And ultimately, we sold that note for around $80,000. So we wound up coming close to doubling our money by buying the note. And also, we felt good because we're able to help the borrower to get back to a reperforming situation. So we, in that particular case, because they were behind in their mortgage, we were able to lower their payment. We stretched out the term a little bit in order to be able to do that and gave them a little bit of a break on their interest rate. So I mentioned covenant fund. I mentioned that we pay somewhere between 8 and 12% on a annual basis to our investors. I want to kind of walk you through. We have four different classes of investors. A Class A investor gets a 12% annual return paid out quarterly. Their investment is a minimum investment of $1 million. Our Class B investors have a minimum investment of $150,000 and they're paid a 10% annual return with a quarterly distribution. Our Class C, it's a 75,000 and up. It's a 9% return, again with a quarterly distribution. Class D, 8%, which is 25%, 25,000 and up, again with a quarterly payout. The idea was we wanted to make sure that we could open this up to a broad range of investors and also, for those investors that are just starting out, be able to get in for a smaller amount. The Covenant Fund is for accredited investors. And one of the things that we will do with all of our investors is to provide them with a questionnaire so that they can come back and let us know that they are truly an accredited investor and meet the requirements of the SEC. One of the other things that I want to tell you about is the Wealth Protection Summit that we have coming up in April the 5th in Ponte Vedra, Florida, which is in Northeast Florida. We wanted to put together this summit is our way of being able to provide a plethora of very knowledgeable folks that can work with investors to help them protect their wealth. One of the things that I've experienced in my life is because of, stock market volatility, it's 2008, I lost millions. 2000, the dot-com bust, I also lost a lot of money. So, and talking to some of the folks that we will have talking to us at the summit, people were telling me about strategies that I could have used that would have helped to blunt some of those losses. I thought that was a really good thing. I thought, they gave me a lot of really good information. So I wanted to make sure that we set up something to pass that kind of information on to others. So Wealth Protection Summit, join us. There's a URL that'll take you to the link for the summit. It's if you I think we have early bird special going on right now. So if you register before the 15th of February, you'll get a $50 discount off of your ticket. Also, we have some discounted rates at the Marriott hotel for those that are flying in. That's a little bit about First Shield Financial. That's a little bit about investing in notes. I'll open the floor up for questions at this point.
Jerry, you said only commercials or yeah. Do you do like businesses, like strip malls or anything? Or you just
No.
no? Okay.
Yeah, for the commercial that we do is really narrow.
Mm-hmm.
So if for in the residential space, they consider commercial a unit that is over five or a property that has over 5 units. So
Right.
it's primarily multifamily
Right.
as opposed to the strict commercial. And so that's kind of that's our buy box. That's the space that we've carved out for the fund.
Gotcha. Okay. Now if I figured that, but I was like, so when did Jerry start doing commercial? But okay.
Yeah, yeah.
Gotcha.
Our expertise is residential, and
Mm-hmm.
we've been doing residential forever. Um, the commercial space is one that, we may set up a fund at some point in the future to do that because we do see a lot of opportunity there, but we don't
Right.
today have the expertise inside our team to be able to really evaluate those types of properties as well as we should.
Gotcha.
Yeah. One of the things that we do pride ourselves on is the due diligence that goes into buying a note. We're looking at the borrower, we're looking at the property. We have eyeballs on that property. We look at the paper, all those kinds of things to make sure that we're buying something that is a quality investment. I know that you have to do those for the commercial side and more. With commercial, you also need to get some engineering studies and engineering things in there as well. and that's kind of beyond the scope of what we do, and beyond the scope of what we our expertise.
Got it. Okay.
So I have a question.
Yep.
Can the investment options be customized, as well as how often would a person like receive performance reports on like their investment returns?
Good question. Very good question. So for the fund, it's it's specific for investors that are looking for a passive income. So there are some things that an investor can do to enhance their position within the fund. We have the ability to compound the quarterly payments if they wanted to, that kind of thing, but not a lot of room there. There are other things that we do inside of First Shield that if someone is very interested in the note space and may not want to be in the fund, that we can work with them to develop some things there as well. So that is an option for us. You also asked about communications. With the fund, we'll be providing a quarterly statement so that people will see how we're doing. Um, but we will also provide regular updates, monthly updates to our investor base so that they get an idea of some of the things that are happening, some of the activities. Um, and we will have a Dropbox where people can actually go out and see the properties that we're invested in. Back in the day, I was a trustee on a public pension plan. And I remember when our real estate funds came in, they would show us properties. And, I remember walking down the street in New York City saying, hey, I'm invested in that office building. So I want our investors to be able to say, hey, that house around the corner, that's one that, I got the mortgage on that. So we will have that information available to them so that they can go out anytime they want and be able to see, properties that we have. We obviously won't be giving them, the details of credit reports and things like that, but they will be able to see the properties. Other questions?
Have you guys just so you going from $1 million down to, I believe the last one was 25,000. What is what if an investor just has like 10,000 or 20,000 at that moment? You say come back, or you just pull it in and
Yeah.
just pass it out based on whatever that percentage comes out to be, or how do you do that?
Um, our minimum investment is 25,
Hmm.
and I'm trying to remember this correctly. I think we sell it in $1,000 units.
Hmm.
So you could buy 26, 27, that kind of thing, but the
Hmm.
minimum is a 25.
Gotcha.
Yeah. And a lot of that is for just administrative purposes. It's a lot easier. The larger the investment, the easier it is to maintain the paperwork and that kind of stuff.
Makes sense. Just curious.
Yeah.
Yeah, I was gonna say I know the times. Actually, I think the title of what this was called kind of speaks on the times that we're in. And I was gonna ask, like, so how secure is like the investment capital,
Mhm.
as well as like the volatility? I guess basically based on like the market conditions. Is there a lot of volatility in this?
Um, Good questions, Henry or Will. The notes that we buy are secured by real property. So let me back up. When the notes are created when a buyer buys a house. When they go to closing, they create two documents. One's a mortgage and one's a note. Those two are joined together. The mortgage says, if I don't pay the loan, you can take my house. The note describes the loan. So the note says, you pay on the first of the month, you send it to 123 Main Street, that's the address. Here's what the interest rate is. Here's how long the term, how long the note is, and that kind of thing. So that's the underlying collateral underneath our note. So because the notes are secured by the real property, there is a pretty, they're pretty well protected and they're very secure. So, and the other thing that happens, and the other thing that we do, and I mentioned it a little bit earlier in the talk, when we buy notes, we also make sure that there's a good deal of equity so that the borrower has a stake in the property. Between those two things, it helps to ensure that we will be able to work something out with the borrower and that when they start paying, or that they will start paying us at some point, or um, the house will be sold and we'll get our capital that way. So a great deal of protection because of some of those contracts that are around the note. Did I answer all your question? Because it was a two-part question. I want to make sure I got both pieces.
Yeah, you spoke to the volatility, but also just as in my first question as well. Like it was very detailed, so I understand.
Okay. Yeah. And again, on the volatility side, which is part, I didn't give as much of an explanation there. There isn't a lot of volatility because it's a fixed number on the house. So the value of the note doesn't change much in the marketplace. We buy them for a pretty good discount, mainly because the borrower hasn't paid. But for performing notes, there's not as much of a spread. There may be a discount, but not as much. So there's not a lot of volatility. So our investors, when we buy, we know what that note is, what the true value of that note is. So there's not a lot of opportunity to lose, I want to say. Any other questions? Well, if none, I will share one final URL. If you do want some more information about what we're doing, if you want some more information about the fund, if you want to know more about note investing, click on this URL. It'll bring it back, bring you to our website and bring you to my calendar. And you can schedule some time for me to sit down and have a one-on-one to discuss notes, to discuss the fund, to discuss opportunities for enhancing your portfolio.